Nancy, what do you think about how this recovery might shape up?
Yeah, that's the million-dollar question, Kelly. You know, we had said at the end of March, about March 18th, 19th, and 20th, we wrote to our clients, we were on the air saying, hey, we think we found a bottom, which is not to say stocks couldn't go lower, but we were really bumping along. And now this rally has been so violent to the upside so quickly, just like the downturn was. You know, that may be the offset. It may be the right thing. But I think as we move forward, it's still difficult to tell whether or not this is going to be a V-shaped recovery or a U-shape or a swoosh, whatever you want to call it. And so last night when you saw the president make the announcement about unrolling the phase 1, phase 2, phase 3 get back to work programs, the futures were up over 900 points. And we've settled back down. So I think there's a lot of noise in the short term, the computer program traders, the movements in and out of ETFs. It's difficult to say that the market's forecasting a strong recovery because some of these moves just don't make sense.
Right. And Bob, that's the big debate. Is the rebound telling us that the recovery will be better than we think? Or is the stock market fooled? And we have other signals for the bond market and elsewhere that paint a more sobering picture. Here's what Brian Reynolds said today. He's focusing, as so many investors are, on balance sheets right now and thinks all of this borrowing to get through this crisis is going to cause a pretty bad hangover. He says the massive growth in debt and transformation of balance sheets will change the focus of companies to debt buybacks in coming years. This will make for a less intense equity bull market than the last three. Bob, would you agree?
I think it even goes further than that. I think if you start to think out how this is going to impact towns and cities and governments around the world, because we're going to have to be paying for these various programs for a very long time. So social programs are going to be impacted. After school programs are going to be impacted. Food stamps even. You know, this is not going to be something that goes away anytime soon. But what the market is telling you is that it's looking out a year from now. In a year from now, economic conditions are going to be better than they are right at this moment. And I think that's what you have to focus on as a long-term investor. The market gives you opportunities. You have to be opportunistic and step into companies that are quality companies, solid balance sheets, market leaders who have real defense positions around their products. And I think as a long-term investor, that's what you want to focus on. You don't necessarily want to try to shoot for the moon with these COVID-19 type of plays, but look for quality companies. And I think that's how you populate your portfolio going forward.
Nancy, who comes up in your kind of like investment list right now?
Well, we still like technology. I feel like a little bit like a broken record, Kelly, but I think coming out of this, in addition, you're going to be in a good position with many of the tech names we own. So we have been adding to Microsoft and some of the names I've mentioned before, Palo Alto Networks, Splunk for cybersecurity, Salesforce. We're actually taking a look at Workday, which has sold off quite dramatically, to see if we want to add that to our portfolio. And then we're barbelling that with a group we were already invested in and overweight in, which is healthcare. But we have added a little bit to some of those names. I thought the Johnson & Johnson dividend increase was very optimistic and good for stocks. So we're continuing to add there, and then also in the consumer discretionary space. Because I agree with Bob. I think, eventually we'll get there. I just think this rally has moved too quickly, and I wouldn't be chasing it. I'd be waiting for some of these stocks to come back to you as a buyer. Chipotle was one we bought on March 20th. It was I think it was at $555, and now the stock's at $800.
Wow.
I mean, I can't justify that in my head. It's a 50% move.
Right. So, Bob, you also are going company by company, looking at Qualcomm, Eli Lilly, United Health, Home Depot. And we've heard, the case is made for those stocks. But let me just leave it on this question about whether you have to be a stock picker, essentially, in this environment. If we're talking about debt overhang, the companies doing better are the ones with cleaner balance sheets and so forth. Maybe you can buy the whole S&P, but certainly if you're trying to buy sectors, this would seem like an awfully hard time to do so.
It is. It's very difficult to even buy index ETFs or mutual funds because you're taking the bad with the good, and that's not what you want to do. You want to focus on companies who are going to have demand for their products as we come out of all this. A year from now, not all companies are going to have the same kind of demand for either the products or services. And so I think if that's what you focus on, that's where you're going to be able to find companies. So it's more bottom up rather than top down right now.
Yeah. No, makes sense to me. Bob Pavlik, Nancy Tengler, thank you both. Good to see you.